have done if you have reconciled your personal checking account. So what we're doing with the bank reconciliation is we're comparing the balance that's shown on the company's books to the balance that's shown in the bank's records, often as reflected on the bank's end of month statement. And we're trying to explain the differences between the two balances. And often these differences arise because of timing differences, but not always, but very often it's a timing difference. So here's an example of what an end of the month bank statement would look like. When we put together a bank reconciliation report, this is an example of what it would look like. There's always, it's for a period of a month. There's always a bank side, which is typically on the left side, and there's a book side, which is typically on the right. And the unadjusted balances are shown near the top. And then after you make various adjustments on both the bank side and the book side, you get to an adjusted balance at the bottom. And you'll notice that the adjusted bank balance at the bottom on the left is exactly the same figure as the adjusted book balance at the bottom on the right. So we've successfully explained all of the differences between the bank balance and the book balance. When we record adjustments on the bank side of the reconciliation, the most common reasons for those adjustments are deposits in transit and outstanding checks. So deposits in transit are when we've recorded a deposit on the company's books, but the deposit has not been received yet by the bank. Maybe we mailed the deposit to the bank, or it used to be that banks would have like a 2 p.m. cutoff time for recording deposits, and if we didn't take it to the bank until 3 p.m., maybe it didn't get recorded that day. So a deposit in transit would always be a positive adjustment on the bank side, because it's something that the bank that would increase our balance if the bank had been aware of the fact that we had made that deposit. Then outstanding checks, those are checks that we had recorded on our books because we had in fact written the checks, but they had not cleared the bank yet. And those, by the way, would always be negative adjustments on the bank side of the reconciliation, because if the bank had been aware of those checks, they would have reduced our bank balance. And then other adjustments are often bank errors. And with those, it's there's no general rule for whether they would be a positive or a negative adjustment, because it all depends on exactly what the error was that the bank made. So if they keyed in a number wrong for what our deposit was, for example, transposed some digits, it just depends on which direction they made the error in that you have to correct. On the book side of the reconciliation, there are quite a few more things that could result in an adjustment. So the first thing is credit memoranda, which typically would be bank reconciliations. Banks sometimes collect on behalf of the customer on accounts receivable or notes receivable. And if we don't find out, if our company doesn't find out until we receive our bank statement that the bank collected from our customers on our behalf, then we would have to make a positive adjustment for those collections on the book side of the reconciliation. Then electronic funds transfers, it depends on whether those are transfers in or transfers out as far as whether the nature of those adjustments. If we had paid an electric bill with an EFT, now the best practice would be that we would record that on our books immediately when we made that EFT payment. But let's say that we had our electric bill set up on auto pay. We probably didn't know until later, until we received our bank statement, what the amount of that payment was. And in that case, we'd have to make the adjustment when we did our bank reconciliation. And in that case, if it was paying an electric bill, it would be a negative adjustment on the book side of the reconciliation. Then there's service charges from the bank. Those would always be negative adjustments on the book side. We wouldn't be aware of those till we received our bank statement. The bank might pay interest revenue on a checking account, although in real life, most checking accounts don't pay interest revenue. But if they do, and we find that out from the bank statement, then that would be a positive adjustment on the book side. Then NSF checks. NSF, if you're not familiar with the term, it's non-sufficient funds. It's the same thing as a bounce check. So if a customer's check to us bounced and we did not become aware of it until we received our bank statement, then that would be a negative adjustment to the book side of the reconciliation. And then finally, we have book errors. So this is where it's not an error made by the bank, it's an error that we made on our books. And we probably became aware of it when we received our bank statement, because our bank statement looks different than what we had on our books. And here again, the adjustment for the book error could be either a positive or a negative adjustment depending on what the nature of the error was. So in this particular example that we were looking at, here's the different adjustments that we have to make on the bank side and the book side. And when we put it all together, this is the same exhibit that we were looking at earlier. This is what our final bank reconciliation for the month of April looks like. We'll go through a practice problem like this together in my lab when we get done with the lecture. Here's an exhibit from the book that I think is pretty helpful. It shows us what adjustments are typically made on the bank side and what adjustments are typically made on the book side, and it tells for each type of adjustment whether it's an addition or a subtraction. And then, as we said before, if it's a bank error or a book error, we can't really say whether it's an addition or a subtraction because it all depends on what the nature of the specific error was. Okay, now after we've completed our reconciliation report, there's some journal entries that we have to make. If the adjustment was made on the bank side, we don't have to make any journal entries for those adjustments because those are things that we were already aware of on our books. It was just the bank that wasn't aware of those transactions. On the other hand, if we have to make the adjustments on the book side of our reconciliation, those by definition are things that we had not yet recorded on our books. They're things that the bank was aware of, but they were not on our books. Therefore, those adjustments must be recorded on our books through journal entries. So here's the journal entries to record those adjustments. And of course, each one of these adjustments is going to have cash either as the account that is debited or the account that is credited. So here you see the first adjustment here is to record the account receivable collected by the bank. Second one is to record the interest earned on the bank balance, et cetera, et cetera. Again, we'll go through an example of this in my lab when we get done. So now that we've posted the journal entries to the cash T account, the ending balance for our cash T account is going to be $19,720. And that will be exactly the same as the adjusted balance that was shown at the bottom of our bank reconciliation. So this means that our books now reflect exactly what our bank reconciliation report reflects.